3M Corporation, ticker MMM, is currently trading at $91.83, and over the past 5 years, the company is down by 40.7%, which is $33. Now, in the middle of 2021, the company has hit a high of $170, and currently it is sitting at $91.83. Now, since 2017, the company has been on a decline due to the many allegations against it. The most known one being the earplug lawsuit, which was agreed to be paid down from 2023 to 2029 and amount to an amount of $6 billion, from which $5 billion would be paid in cash and $1 billion would be paid in stock. Now, MMM is also under the lawsuit against the general public, who claim that their so-called forever chemicals have contaminated public drinking water, and this lawsuit will amount to an amount of $12.5 billion. Now, MMM has agreed to pay the $18.5 billion in settlements, which to me is certainly a good sign. Now, jumping to tip ranks and going to the analysts' forecasts, we can see that the forecast isn't as positive. Out of 9 ratings, 7 are sitting at a hold, 1 is sitting at a sell, and 1 is sitting at a buy. Now, the analysts do project a 15.8% upside, projecting a price per share of $106 by the end of April 2025. Even though the analysts are a source I don't really like to look at as I find them incorrect many times, it is good to have someone else's opinion. Now, to have a closer look at MMM and really figure out its intrinsic value, we'll jump over to my stock valuation spreadsheet, where we will simply plug in the ticker symbol of 3M and all the metrics will show up automatically. Now, I created these spreadsheets for my personal use as I find it much simpler to figure out the intrinsic value of a company using these spreadsheets, as all the processes are automated. And so if you find these spreadsheets helpful or interesting, you can access them at my Patreon at the link in the description. Now, getting straight into the valuation, we can see that the dividend yield of the company is currently sitting at 6.6%, with a dividend payout of $6 per share per year and a trailing payout ratio of just below 80%, which is quite a high payout ratio. Now, the analysts predict a price of $107 by the end of this year, and the company has a beta of 1.02, which means that its volatility will be fairly similar to the one of the overall market. Now, jumping to the most important slide, the 9-pillar analysis, we can see that 8 of the 9 pillars are in the green, with the 5-year PE ratio and the price to free cash flow both sitting below the values we want to see. Now, the revenue growth is sitting quite low, sitting at only 0.08%. If we scroll down to the financials and go to revenue, we can see that the revenue indeed did not grow by much over the past 8 years or so. Now, we can see that the free cash flow is increasing by 2.84% per year on average. Now, from this, we can see that 3M does have a strong enough free cash flow to support the paying down of the allegations against it. Now, the issue I have with this is that while they pay off their allegations, if we go back to the stock screen, we can see that the trailing payout ratio is sitting at 77%, and with paying off their allegations and the free cash flow, and with the dividends being paid from the free cash flow, we can expect a dividend cut within the next few years. Now, going back to 9 pillars, we can see that MMM does have decreasing shares outstanding and that the long-term liabilities of the 5-year free cash flow negative dividends is sitting at 2.88. The allegations don't fall into the long-term liabilities. Now, the consecutive dividend growth is sitting at 4.72%, and as I stated before, I believe that there will be a dividend cut, so this is something we won't really look at. Now, going to the first valuation model, the Grams formula, we take the Grams formula revised. The earnings per share, the base PE, the 5-year growth estimate, the growth rate multiplier sitting at 1.5, the average yield on AA Corporation bonds, and the current yield on AA Corporation bonds, which is sitting at about 5, but the short-term average is sitting at about 3.4, so that's what we will be using. And when we plug all this in, we can see that the intrinsic value comes out to be about $205, which is 55% higher than the current trading price of the company. Now, going to the discounted cash flow model, we can see we take the free cash flow of the company over the past 8 years or so and get an average growth rate at 1.35% per year, which is quite low of a growth rate. Now, the analysts do project a growth rate of almost 8%, So taking these two metrics into account, I can project a growth rate of about 4%, being quite conservative. Now using the calculated growth rate, we calculate the future value of the future free cash flow, and after that, using the discount rate, which is sitting at about 6, we calculate the present value of that future free cash flow. Now summing up all of that future free cash flow, adding any cash and cash equivalents, and subtracting total debt, we get an equity value, which we divide by the shares outstanding, and get an intrinsic value of $283.83. Now, investing into a company that is a little more high risk, which MMM currently is, we would generally like a higher discount rate. And the discount rate is basically the amount, the percentage of the revenue you want returned from the revenue you invest into the company. So if we plug in 8%, we can see that the intrinsic value falls down to $183 as we want a higher return. Now we will keep it as this, and we will move to the multiples valuation, which we will actually skip, as there isn't really a company in my eyes that we can compare to MMM. Now moving to the final valuation, the dividend discount model, we take the dividend payout over the past 5 years and calculate the growth rate to be sitting at 0.94. Now, as I do believe that there will be a dividend cut, I will plug in a projected growth rate of 0.5%, and with that we get an intrinsic value of $121.26. Now we can move to the ultimate valuation model, where we have the Graham's formula, the discounted cash flow, and the alternative dividend discount model, which we combine and get an intrinsic value of $165.31, which is 80% higher than the current trading price of the company, and with a margin of safety of 20%. As the company is a little more high risk, we get an acceptable buy price at $132.25, which would be a buy at its current trading price. Now, obviously, using these spreadsheets to get an intrinsic value of a company isn't the only evaluation you should make before buying a company. You have to do your own research in the back end and look at various other factors. Now, if you did enjoy this video, make sure to leave a like, subscribe, and let me know down in the comments which company you'd like me to evaluate next.